Welcome, it's Drew Blazik with Logos and Markets, and this is video number 2 on our advanced bond calculator. If you haven't seen video 1, you want to do it, you can go to my website, get the Excel sheet. You can follow along if you wanted to. If you're curious if this is something that you would want to incorporate, the techniques I'm using in Excel for your business, your corporation, or education, please send me a message and I'll be more happy to meet with you. So let's get started. So where we ended up last time, what we did was we solved a treasury bill, which is very simple. And then we left it there. And then we did a corporate bond. And I introduced coupon rates. I introduced yield to maturity we solved. I introduced current yield, what that was, capital gains. And then we did yield to call. And in this video, we're just going to do durations. So this is where we ended up last time. And we got tons of work to do, but I'm going to break this down in different videos. So what I want you to do, and I kind of debated with myself, was um, should I show you the equation for duration? So look it up online, have the equation there. I'm going to talk to you through it. I'm going to talk to you how to solve it, and I can explain what it is. But look it up, or if you have a PowerPoint, look it up that way. But just do a quick search on Investopedia or even AI. Just ask AI, give me the equation. But I break it down here, but we're going to build a dynamic model in this regard. So let's get to it here. First thing what I'm going to do is let's bring in some data that we can look at. Okay. So what I want to do is let's bring in what is our coupon payment. So we're going from the corporate bond worksheet and we want to plug those in. So I'm going to go, well, that's going to be equal to the coupon payment, which is 15. So this is why you must label, if you're going to build your own model, you want to label things that cells, formulas, or not formulas, but yeah, formulas you could say, but different cells, you want to label them, give it a name if you're going to go do a different worksheet, because you want to reference that. And what it gets really annoying is saying equals, going to that sheet and looking for it. Now, some models you have to because too many variables, but in this one, bonds, we can just do it. So now we want to know total number of payments. That was the NPER. That'd be 40. Let's bring in the par value. That was the 1,000. Let's bring in the yield to maturity. Let's bring in the price. And then we got our years. Oh, what did I name it? Did I name it something? Oh, I forgot. So problem is sometimes you forget. Probably a horrible name. MAT is for maturity, but that's for years. So it matures in 20 years. So we got all our variables there. What I'm going to do is, and this is just for reference to my point because this is more of a complex model. I want to make sure I have the same. Um, I'm gonna go back to my coupon rate of 6%, so we know that we're doing it the right way with the variables. So, okay, so we got our all our stuff. Everything looks good. So what we want to do is I want to build a dynamic model. First off, is with the duration. What we want to do is we want to build um, how many we want each payment. So let me explain what duration is. Duration explains of how long through the cash flows. If you receive, what are the cash flows? Well, we're getting right here. We're getting what coupon payment $30 per 6 months. How many times do we have to get paid that in order to get paid back the price that we paid? So how many years will it take for all the payments to get paid back 900 bucks? That's what duration is, and how many years you get it back. So if you could imagine, there's two cash flows you want to think about. You have coupon payments, could be annual or semi-annual or monthly, and then you also have the par value. So if there is zero coupon payments, if this was zero, that means our duration is always the maturity, right? We get our money back at the $1,000. So that's at the very end of the bond. So that's a very easy way to calculate it. So the calculation of duration, if you want to look it up real quick, is what we're going to do is we're going to sum up all our cash flows. So we're getting $30 this period, $30 the next period. And this is every 6 months. So this is much more difficult. If I was doing years, it's a lot easier. So we're gonna get those $30, and what we want to do is we want to multiply it times t times the time. So and that's why I need times in years. So if I was doing years, if this was coupon payments each year, that means the first one was $30 and we multiply it times t. And then I want to find the present value of that. So I'll need to discount that to the present value as well. And then we're going to divide all those cash flows. We're going to sum those up, and then we're going to divide it by the actual price that we paid. And then whatever pops up, that'd be the duration right here. That's going to be the total years it took in order to get our money back through the cash flows for what we paid. That'd be the duration. So if we had, what's NPER here? NPER right here is 40. So I could type just 40, but we want a dynamic model, okay? So what I'm gonna introduce you to, so I have that gray cell, so you only have to do this one time. It's a great function. So what I'm gonna do, this is called sequence. So sequence is a very powerful tool that you wanna get used to. So I'm gonna hit tab. I'm gonna use this in this model a few times. So we want to know sequence. The first thing is rows. Well, rows are going to be our NPER. So I'm going to type in NPER. So rows is going to be the 40. That's going to be 40 rows. And then next I'm going to do is I'm going to hit comma. It's asking for columns, one column, right? Comma. The next is when does it start? Now, this is important when it comes to the yield to worst. We're going to calculate that. But it's going to start at the first time. So we're just going to hit 1. So we could start this anytime. So if you can imagine if the yield to call is the 5th year or the 5th payment, whatever we're looking at there, we could say I want it to start on the 5th. So sequence is very powerful. And then we hit comma. And then the last thing it's asking for is step. Do I want to go by 5s? Do I want to go by 2? Well, I want to go by 1. So I'm going to hit a 1. So watch what happens. I'm going to close that up. And it perfectly gives 40. So let's go back to our corporate bond where we can enter things. What if I hit 2? I get a little excited for these Excel functions. Look at that. It is dynamic. It automatically calculates. This is so important because what you could have done was I could have just had numbers go down 1 through 1,000. But if we're going to build a dynamic model, we need this to be blank because we need to build a model that if it's blank, we don't want to calculate. And that's important for duration. So let's go back. I'm going to do the 20 years. All right. So the next thing what we want to know is we want to know the time in years. So what does that mean? Time in years. It means if it's every 6 months to find duration, because we have to multiply, remember, each cash flow times T when you look at the equation. So if the first cash flow is in 6 months, you have to multiply it times 0.5. So this is semi-annual. So I want a dynamic model to automatically do is it 0.51, 1.52, 2.5, or it could be every month or yearly. So let's build a dynamic model here. We'll do the same thing. It's going to be sequence, hit tab. And the first thing I want to enter is NPER. That's the first thing. I'm going to hit comma. Next thing it's going to ask for column. Stays the same. I'm going to hit 1. Now here's the difference. Now it's asking is when do I start? When do I start? So I want to start at 1 divided by periodic payment. Hit tab. So the periodic payment is, if it's every 12 months, it'd be 1 divided by 12. It'd be perfect. It'll start the first month. So that's perfect. I'm going to hit comma. Next is what do I want each step to be? Well, I want the same thing. I want it to start at the first payment. This is every 6 months. And I want to add up every 6 months. So all we're going to do is 1 divided by PP again. Very simple. Close it up. Look how perfect that is. It gave us 6 months, 1 year, 1.5, 18 months, 24 months, 30 months. So it goes perfectly that we needed. And it ends nicely right there. So what is that? That's 20 years, right? It's exactly what we need to calculate duration. Okay, so we got our NPR. Those are the two most important parts if you really want a dynamic model in here, to make sure you did it correct. All right, now what we're gonna do is the present. I'm gonna break this down because remember, what what I'm gonna do is I'm gonna calculate the present value of that cash flow. So again, if you look up the equation, what the equation is, we're looking at every cash flow. I want to find the present value when it happens. We multiply it times t, and we sum all those up, and then we multiply. We sum them up, and then we're going to divide it by the price. That's what we're going to do, and we'll do that last. So what we want to do is find our dynamic model. So if you can follow along, this is going to be a little more complex, and I'll explain as we go. Because I need to sum up all those present values. We have to sum those up. And I want this equation to go way down. And what I went way down because I want this dynamic where you could choose 1,000. You could choose any unconceivable bond. Let's say 1,000-year bond. I want it to calculate that exactly what year it calculates. Make it dynamic. However, if it ends right, it ends right here. I want this to be blank because I need the sum of all those present values summed up, and I can't have an error code if this is 0, and we don't want to sum up error codes because then it becomes an error. So this is what I'm going to do here is, so let me explain as we go. So we're going to go if, you don't have to memorize this, but you have to understand it. And I think it comes in. So the first thing we want to know is what is our logic here. So I want the B5. So what I'm going to say here is I want to say is the logic is this year, and I'm going to say if it's equal to, so it means nothing about the duration equation. This means everything about making it blank in this dynamic model. If it's equal to, and I'm going to do double quote means it's blank. So I'm saying is if this is blank, that's all it means. If this is blank, I'm going to hit comma. What do I want this to be? In other words, if we get down here, if the years are blank, I want this to be blank. Very simple. If this can be blank, I want that to be blank. And then comma, if it's false, okay? So now we're saying, is it false? Now, I have to do the other if function because this is important, is think about a bond. Think about cash flows. Well, let's talk about this cash flow. This is 40 payments for 20 years every 6 months. Think about each cash flow. 6 months, you get $30. A year from now, you get $30. 18 months from now, you get $30. 30, 30, 30, 30. However, the 40th year, your cash flow is 1,030 because you get the par value at that point. So we have to have a dynamic model that this calculates the present value, but if it's the last year, I want it to add in the par. So that's why I'm doing another if function. So what we're going to do is we're going to go if. Okay, so what I'm going to do is if B5, so I'm going that years again, right here. If B5 is equal to NPER, I want you to really think what that means. If this year is equal to the 40th payment, that means that's the year I'm going to add in the par value. So if it's equal to that, I'm going to go comma. Again, I don't memorize these equations. I totally understand this equation, right? But I'm following off what I've done. So don't think that you have to really memorize it. But if you understand the logic, it becomes powerful. So I'm going to do a bunch of brackets here. I'm going to go 1, 2, 3. And what I want to do is, and you'll see how the brackets, if you don't do it now, you do it as you go and you have to go back and close them up and you'll see why. So I'm saying is if we're in that last year, that's all it means. I want the coupon payment plus the par value, right? Totally makes sense. And then I'm going to close it up. I'm going to close it up again. And then what I'm going to do is I want to divide it by, and then we're going to divide it by, and I'm going to hit. So remember, we're finding, oops, I didn't mean to do that. Let me make sure I'm at the right place. So we're trying to find we're discounting the last cash flow that we did. So we're trying to find the present value of that last cash flow, what we're doing here. 1 plus, and what we want to use in this example is yield to maturity that we solved. Now, let me just break down something real quick. We solved yield to maturity. If we were solving price, that means that would have been the required rate of return. If we're solving price, I'm not solving price. We solved yield to maturity. So yield to maturity in this example became the required return. And then what I want to do is I'm going to take that yield to maturity and I'm going to divide it by PP, the periodic payments, because I need to divide it by, I need to find the yield. That's the annual yield, but we're in 6 months. I need to find that 6-month yield. And then I'm going to do it to the power of, and then what we're going to do is B5. Okay. Oh, but I messed it up. Accidentally hit tab. Yeah, I'm missing a bunch of stuff there. Okay. So couple notes I want to say right here. So only if we're in that last year, so that's what we're calculating is, and see what we did. I did to the power of, I divided by the periodic payments, but I did the power of the 40th payment, which would discount it appropriately to the present value. So that looks like a good model. So then I'm going to close it. And I think that is good. We have everything that we want for if we're in that last period. And then if that's false, that we're saying is we're not in the last period, I'm going to hit comma. Now what we want to do is calculate if it's every other year. So we're just calculating the $30 every 6 months. That's what this is going to calculate. And what you want to do is, where are we at here? I want to do 2 brackets, and then I want to do the coupon payment. Do the coupon payment, and I'm going to close that up. That's just how I did it. I'm sure you don't have to have all these brackets. And then I'm going to divide it by, similar to what we just did, I'm going to divide it by, I'm going to hit bracket again. I'm going to hit 1 plus the yield to maturity. Same thing we did. I want to find the interest per period. So I'm going to divide it by the PP, periodic payment, and then I'm going to do it to the power of, and that would be the B5. And all it means is if we're in this row, and I'll explain it, we're in just in that that first row right there. All right, and then I'm going to close it. So I think it looks good. 1, make sure I look at it. 2, and then 3. And if you notice when you do it, if I want to backtrack real quick, that last one, watch when I put a bracket there, this lit up. So now I know I closed it appropriately. Now, some of you might get some errors. Let's say you put a bracket, pause the video, look that over, and you can see if it's done correct. All right. So a couple things I want to bring up is I'm sure you're aware of if you hit function F4, what does function F4 do? It freezes a cell and makes it an absolute value. If you notice, I didn't do any function F4s, and sometimes it gets confusing. That B5, I want it to drag down. So when I drag this down, I want it to drag down to this one. This will become B6. And it's going to do the same calculations here. Is this the last? Is this the NPER? If it's not, it's going to calculate it. Then I want B, is it outside of the NPER? If it is, I don't want it to calculate. So all the variables that we named would have been a absolute fixed value. So instead of doing dollar signs, I just named it, which means if I drag it, it doesn't drag. If you understand Excel, it doesn't drag it to the next cell. It always calculates CP, makes it an absolute value. That's another great reason to have it. All right, let's close it up. And that is correct. The present value of that future cash flow of $30 is 29. So what we want to do, if we drag this down, it's finding the present values, doing it perfect that we wanted. But what I want to do is I already have, I believe I have it. So I remember I did this a few months ago and I don't remember it. Um, if I hold down Control Shift, it's going to go all the way down to the last calculated field, which I don't even know what it is. Well, I'm going to hit. Uh, so I highlighted the calculation that we did. I hit Shift. As I'm going down and holding down Shift, you can hit Control D. It brings down the values. If I hit Control Shift, it goes down to the last cell that has a number in it. I'm gonna hit Control D and I'm gonna show you something real quick. So I'll show you a little trick. So look how perfect this did. It ended right there. So it didn't calculate it because it made it blank. We did the double quote. I'm gonna hit Control and go down and see how that last value was an error right there. Um, what I did, how do I end there? If I hit Control down again, it takes me down. I don't have the I don't like headings, but you can see how far down. It took me down to over 1,000,000 rows. So here's a little trick I did is if you know I went down to 315, you can go down to 5,000 if you wanted. However far you want to go, all you have to do, let's say I want to go down to 10,000. I'll show us a little trick real quick. Sorry if it's off topic here. I'm going to go to F10,000. If I hit the space key, oh, it's locked. Sorry, I forgot. If I hit the space key, it automatically becomes something entered into that cell, even though there's no digits or no text. So if I hit Control down, it would stop on the 10,000th. That's what I did here. I hit space, I hit space, I hit space. So we end at 315. So just a quick little technique. Okay, so we got the present values. Next, and if we didn't go step by step, it's much more complicated, this equation, and a greater chance you'll have an error within it. Next, we want to do is we want to multiply it times t. So what we're going to do, and I'm going to go back and I'm going to correct this function to show you what I would do later on. But what we're going to do is we want, I'm going to go F5 in this cell. Hold on one second. I'm going to make sure. Yeah, make sure I was doing everything correct. All right, so what I want to do is I'm going to go to F5. That's right beside us, an F. And then I'm going to multiply this times our D5, which is going to be our time. So I'm taking the present value, very simple. I'm going to multiply it times the years. So we already did the present value, and this works perfectly on it. And then I'm going to hit enter. Okay. Now I'm going to go all the way down, hit Control. So I'm going to hold down. If I hold down Shift, I can go down, look further, and Control D. So you hold down Shift. I'm going to let it go. Hit Control D. It goes down. If I hold Control Shift D, it goes all the way down to the last one. Big problem here, though. It gave us a bunch of values. Or did it? Hold on, let me see. I thought it did. It gave us a bunch of values. We cannot have that. If I'm going to sum those up, I don't want values. So what I'm going to do is I'm going to do a function within this, and I'm going to go in front of the F5, and I'm going to select a if error function. This is a very powerful tool. I use it all the time. If it is an error, if that cell says that it's an error, now that number is not an error. So I'm going to hit comma. Now it's asking is what do you want if it's an error? So a lot of people could put NA in it. They could say error. They could say whatever you want to say. If it's an error, you could put a number in it. If you want to put a word in it, you want to put quotation. But all I want to say is I'm going to put double quote. If it's an error, I want it to be blank. So I'm going to go Control D. Oh no. I think that is, so I'm just going to go all the way down to this part. I think that's the reason why. There it goes. Do I have this protected? For some reason, so far I can go down. Must not have. All right, it works there. So yeah, if you run into that, it kind of ran into a protected cell on the bottom. Apologize about that, but that's what it did. But we went pretty far down. So now it's dynamic where I could change this. Let's go back to the corporate bond. I could change this to 30 years. And it's automatically going to calculate. Look at that. It's going to go up right there to the 60th one. So everything's dynamic and it stops. And look what it did. What it did was it calculated the present value of that last cash flow that we have. So, and it's times T, by the way. So that's 139. That's what it's worth. So you see how it goes down? It's going down because that's just $30. And then the last in 30 years, we won't find the present value of 1,000 plus a 30, which is only 139. So it's dynamic. It works perfect. If you're building your own, you may want to go down further than 300. I think that's plenty. I mean, I don't think any bonds would go beyond that. But I think this is a good analysis there. So, okay, so we go back all the way top. We've got 20 years. And then the last part that we have to do is actually, all right, never mind. I thought this would be much more complicated, but it's not. So now we got to find the duration. So what we're going to do is I'm going to go equals, and I'm going to go sum. I'm going to sum this up, and I'm going to go all the way down. I'm going to go, I think it's that last cell I'm getting errors in. So I'm going to hold down shift. I'm going to go one up. So I'm going to close that up. So that is the sum of all the present values multiplied times t. So it's exactly the top part of the duration equation. That's what we just solved there. And all you want to do here is, I'm going to pull it back up. I'm going to divide that by the price. That is our initial investment, what I paid. This is the present value of all future cash flows. And then this is going to tell us in the 11.45 years, we will receive our $800 back in present value dollars. So it takes 11.5 years to work out. There you go. That's a dynamic duration calculation. I'm taking it. You know what? I know it helps out when you have those cells. I like to type in cells when you do it, but I hate having headings. I like to look like Excel sheets to look like a PDF file, and we're just working with it. But there you go. Next thing we're going to do is in the next video, we're going to do something called sensitivity analysis on it. And we're going to analyze the different stuff, and we could talk about duration. That's where we're going to calculate the modified duration, and we'll explain what it means. Then after that, what we're going to do is, once we calculate all that, we're going to plug in our, actually we could do that right now. So I'm going to go to duration, and I'm going to go equals, and I'm going to plug in our duration. And if you notice, it says equal duration. I call this cell duration in that regard. So we calculate that. So next what we want to do is we're going to do the modified duration. And I think the next video, I'm not going to go yield to worst right away. We're going to find the sensitivity analysis, and then we're going to do all this here as well. And I'm going to show you what convexity means when it comes to bonds. We're going to show it. I'm going to show you the graph. We're going to have, it's like a U-shaped or a curved out shape. And then I'm going to show you an example of a straight line. So that's going to convexity compared to a straight line. The duration will give you a straight line, but in all, with numbers, the bond prices actually is more convexed, how it changes. What we're analyzing is the price and the yield change. So, let me pull up that, and I think that's it. So God bless. Appreciate everything. Lost to be Christy. I'll see you in the next video. Please make sure you follow it, and if you haven't followed the first video, make sure to do that so you can get caught up. And again, Logos and Markets website, I should have all the Excel file. I'll make sure I put it up there. This is definitely more advanced. And again, I want to emphasize, if you're interested in these Excel sheets for learning for different kind of educational purposes for corporations or colleges or high schools, let me know. I build these. Contact me, Logos and Markets website. Thank you. God bless.